Hey everyone, welcome back to Corporate Decoder, the place where we uncover the hidden truths in corporate filings by making them sound like something a normal person can understand. And trust me, we have quite a story to decode today, because this filing feels like reading the prologue to a financial thriller, full of elections, interest rates, and even a bit of tariff drama. This is not your average report you see, this is a certified shareholder report for a registered investment company, the Sector Rotation Fund. Normally these reports are dry, but this one is packed with insights on how this fund navigated a pretty wild economic landscape over the past year. From October of last year to September of this year, let us dive in and see what really happened. So at the heart of this report is the performance of the Sector Rotation Fund, and for the year ending the 30th of September 2025, it returned a solid 14.40%. Now that sounds good, right? But here is where it gets interesting. It underperformed the S&P 500 index, which saw a much higher return of 17.60%. So the fund made money, but it did not keep pace with the broader market. Why the underperformance? Let's dig into what the report says affected things. The big three for the past year were the presidential election interest rates and tariffs. Apparently, the election brought back a familiar face, Mr. Donald J. Trump. This meant decision makers had a playbook to draw from his previous term. Inflation was pretty moderate at 2.90% year over year, and the Federal Reserve actually cut interest rates 3 times, bringing them down to the 4.00 to 4.25% range. Now, tariffs, that sounds like it could cause some chaos. The report mentions that President Trump went all in imposing them on most of the United States' major trading partners. Economists like the one writing this report found it hard to keep up because the tariff policy seemed to adjust constantly. This meant a steady hand was needed to avoid making bad investment choices. Despite all this uncertainty, the report claims the fund weathered the storm and navigated to safer waters. Now for the fun part, what did they actually invest in? Looking back to the 30th of September 2024, the top sectors were information technology, communication services, and industrials. And guess what? Those same 3 sectors remained the top holdings as of the 30th of September 2025. That streetability suggests a consistent strategy, but did it pay off? On the flip side, the bottom performing sectors were real estate, consumer staples, and healthcare. The report states the fund managed to avoid real estate and consumer staples, but it did hold healthcare. This holding apparently had a negative impact on the fund's total return. So while they were overweight in the performing sectors, they were also overweight in a laggard sector. Let us look at the actual numbers here, is how a hypothetical 10,000 investment would have fared from the 30th of September 2015 to the 30th of September 2025. Our sector rotation fund NAVX would have turned that 10,000 into $27,218. However, if you had put that same 10,000 into the S&P 500 index, it would have grown to a significantly larger $41,530. That is a pretty big difference over 10 years. Looking at average annual returns for the last year, the sector rotation fund returned 14.40%, while the S&P 500 returned 17.60%. Over 5 years, the fund returned 11.85% compared to the S&P 500 S16.46%, and over 10 years the fund is at 10.53%, while the S&P 500 is at 15.29%. The trend is clear. The fund has consistently lagged behind the broader market. Now let us talk about size as of the 30th of September 2025. The net assets of the fund were just over $41.9 million. This is a decent chunk of change, but for context, the S&P 500 fund we just looked at had an equivalent of over 41.5 thousand. If that 10k had invested in it, so the fund is growing, but not as fast as the market. Interesting. The fund has only 9 holdings. This means it is a very concentrated portfolio, which can lead to higher volatility and greater risk, but also potentially higher rewards. When things go right in this case, it seems to have led to underperformance. The total advisory fee for the year was $388,910. This is the cost of having the fund managed. If you look at the expenses section later, it explains this is 1.00% of the fund's average daily net assets. And get this, the portfolio turnover rate is a whopping 136.35%. This means they are buying and selling a lot of assets throughout the year, which can lead to higher transaction costs and short-term capital gains that are taxed more heavily when realized. Let us look at where the money is invested as of the 30th of September 2025. Communication services makes up 20.2%, technology is at 17 19.8%, and industrials at 17.7%. These are the same top sectors we saw earlier. And who are the friends in these sectors? The top holdings are mainly ETFs from Vanguard, including Vanguard Communication Services, ETF Vanguard Information Technology ETF, and Vanguard Industrials ETF. They also hold the SPDR S&P 500 ETF Trust, which is the index fund they seem to be underperforming. They also have a significant chunk in Vanguard Consumer Discretionary ETF at 14.2%. It is important to note that some of these ETFs are leveraged or inverse ETFs, which means they employ complex strategies that can magnify both gains and losses. And here is a real eye-opener. A holding in ProShares Ultra Pro Short QQQ. This is a highly leveraged inverse ETF, meaning it is designed to go up when the QQ index goes down. Its presence suggests the manager might have been betting against the tech sector or trying to hedge very aggressively. Let us look at the statement of assets and liabilities as of the 30th of September 2025. The net assets were $41.911 million. This is basically the total value of everything the fund owns minus what it owes. The investments at value are listed at $41.963 million. This is interesting because the cost basis was only $24.994 million. This means the fund has experienced significant unrealized gains. Total assets are $41.983 million, and total liabilities are a relatively small $71,549. The net asset value per share is $18.05. Now, for the statement of operations for the fiscal year ended the 30th of September 2025, total investment income was $510,485, but expenses were quite high at $741,380. This resulted in a net investment loss of $230,895. However, the fund managed to make $948,756 from realized gains on investments, and a massive $4.637 million from the change in unrealized appreciation on investments. So combining all this, the net increase in net assets resulting from operations is a healthy $5.355 million. Looking at the statements of changes in net assets over the last 2 years, we see a consistent pattern of growth. For 2025, it was $5.355 million compared to $9.521 million in 2024. So profits are still good, but they came down from the previous year. The realized gains also decreased from $2.8 million in 2024 to $948,756 in 2025. And the unrealized gains also dropped from $6.8 million in 2024 to $4.6 million in 2025. This aligns with the market performance we saw earlier. Overall, the net increase in net assets was $3.895 million in 2025 compared to $8.571 million in 2024. The fund is growing, but at a slower pace. Let us peek at the financial highlights for a share outstanding. The net asset value at the beginning of the year 2025 was $16.88. The total from investment operations for the year was $2.31, and the net asset value at the end of the year was $18.05. This gives us that total return of 14.40%. Interestingly, the net expenses to average net assets is listed at 1.91% for both 2025 and 2024, and the portfolio turnover rate, while lower than the previous year, is still very high at 136.35% in 2025 compared to 309.04% in 2024. That high turnover definitely adds to the cost of managing the fund. Now, a quick look at the notes to the financial statements is always important. The fund operates as a series of the Starboard Investment Trust, and its main goal is capital appreciation using a sector rotation strategy, which means they are trying to predict which sectors of the economy will perform best. All investments are carried at fair value. This means they are valued based on current market prices or careful estimates, if market prices are not available. The fund uses a framework to measure fair value based on 3 levels. Level 1 uses readily available market prices, Level 2 uses other observable inputs, and Level 3 uses unobservable inputs. The good news here is that as of the 30th of September 2025, all of their assets, which include exchange-traded funds and short-term investments, were valued using Level 1 inputs. This means they are primarily invested in highly liquid assets with readily available market prices. The fund pays an advisory fee to Grimaldi Portfolio Solutions Incorporated calculated at 1.00% of its average daily net assets. They also have an expense limitation agreement that caps total operating expenses. The fund also incurs distribution and service fees up to 0.25% of its average daily net assets, which is for marketing and shareholder services. Of course, no filing is complete without a discussion of risks. The fund, like many, is susceptible to cybersecurity risk, meaning a breach could disrupt operations and lead to financial losses. Since the fund invests in ETFs which can hold foreign securities, there is a risk associated with foreign economies and political changes. Investing in ETFs means the fund shares in the risks of any underlying ETFs, including market price fluctuations and layering of expenses. And here is a big one. The fund may invest in leveraged and/or inverse ETFs, as we saw with the ProShares Ultra Pro Short QQQ. Holding these can magnify gains and losses significantly and are generally considered riskier. The high portfolio turnover rate also presents a risk of higher transaction costs and potential for short-term capital gains, which are taxed more heavily. Because the fund focuses on specific sectors like technology and consumer discretionary, it is particularly sensitive to economic factors affecting those sectors. For tax purposes, distributions are characterized as ordinary income, and capital gains the report details those amounts for the fiscal year. And finally, the signatures confirming the accuracy of this report. So what is my take on all of this? The sector rotation fund has managed to grow its net assets and provide positive returns, which is always a good start. However, its consistent underperformance compared to the S&P 500 is a major red flag. The high portfolio turnover and the inclusion of aged inverse ETF suggest a strategy that is trying to be very active and perhaps even aggressive in its sector bets. But this strategy does not seem to be paying off, especially when compared to simply tracking the broader market. The fund is facing risks like cybersecurity and foreign securities, but the most pressing risk appears to be its own strategy not generating market-beating returns. The fund has shown some ability to generate unrealized gains and manage its liabilities. Well, but the core question remains, why pay for active management when a passive index fund is delivering significantly better results? With a 1.00% advisory fee and high turnover, the costs are also a factor to consider. The fact that they are InVev, TED in ETFs that are themselves diversified also makes the concentrated holdings of just 9 sectors even more impactful. A positive for the market is that the fund did not have any level 3 fair value measurements, which means its holdings are easily valued. The S&P 500 index fund's performance is a strong comparison here and shows a simpler and more effective approach for investors looking for broad market exposure. So the direction of this fund seems to be a continuous effort to pick sectors and time the market. This is an inherently difficult task, and the results here show it is not consistently succeeding. The opportunity lies in the potential for successful sector rotation, but the risk is significant given the historical underperformance and the complex instruments being used overall. This fund, like many, actively managed. Yay. Sector funds faces a strong headwind from low-cost passive index funds that are often more effective for most investors. Alright, that is our decode of the Sector Rotation Fund report. What do you think about their strategy and its results? Let us know your thoughts in the comments below. If you found this breakdown helpful, please give this video a thumbs up and subscribe for more corporate investigations. Don't forget to join our Discord community for deeper discussions. It is linked in the description. Thanks for watching. Until next time.